In his book, The Behavior Gap, author Carl Richards showed us the difference between the performance of an investment and the performance of a typical investor over various periods of time. His goal was to show how important investor behavior is when it comes to investing success. This is because you can, in theory, earn the same returns as an investment, minus a little bit for taxes and fees, if you invest your money in the investment and then just don't touch it. You don't buy, you don't sell, you just hold the money in the investment. But real people rarely invest this way, at least over the long haul. Richard, who is one of my fellow financial YouTubers from the channel The Plain Bagel, covered a few specific investing traps that make it psychologically difficult for us as investors to eliminate that behavior gap. In his video, Investing Won't Make You Rich, probably. You can check out his full video at the link in the description below, as well as in the card in the upper right-hand corner of your screen, and I highly recommend you do so because the 3 traps we're talking about today are basically the same as the ones that he talked about there. But I really enjoyed hearing his take on the idea, so I wanted to take a moment today to look at those psychological traps he mentioned and show just how devastating it can be to fall into them as investors by putting some numbers to each trap. So with that being said, let's get started. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. The first psychological trap Richard mentioned that's keeping us from reaching our full potential as investors is loss aversion. Loss aversion, in cognitive psychology and decision theory, refers to people's tendency to prefer to avoid losses in comparison to acquiring gains. This means that from a psychological standpoint, most of us would feel that it is better to not lose $500 than it is to actually find $500. One example that my investing professor from college used to explain this concept was to say you were going to flip a coin, and if it came up heads, you would win $500, but if it came up tails, you would lose $500. Would you agree to flip the coin and take the chance? Technically, from a probability standpoint, your odds of winning and losing are even. There's a 50% chance you're going to lose 500, and there's a 50% chance you're going to win 500. Therefore, your expected gain and loss from flipping the coin is exactly 0. If we change the game so that flipping heads wins you $600, but flipping tails loses you $500, your expected gain or loss from flipping the coin changes to $50 per flip. However, that's just based on pure probability. And pure probability is not how most of our brains are wired. In other words, most of us are at least a little bit loss averse. The question then becomes, how much money would you need to win for the coin coming up heads before you're willing to play? Some studies have actually gone so far as to suggest that losses are felt twice as powerfully from a psychological standpoint as gains are to the typical person. If true, this would suggest that the typical person, at least based on the samples those studies have used, would have to make at least $1,000 if the coin came up heads before they'd be willing to take a chance of losing $500 if the coin came up tails. The second investing trap that Richard mentioned that's keeping us from reaching our full potential is anchoring. Anchoring is quite simply a cognitive bias where individuals rely too heavily on some initial piece of information when making their decision. This piece of information is often referred to as the anchor point, and you often hear about this in negotiation. If you're trying to sell a car for $5,000, a savvy salesman will start the negotiation above $5,000 and then work their way down towards that point. This is because the buyer will have their mind anchored to the initial offer and will feel like they're getting a better deal when they finally negotiate their way down to the $5,000 mark. What's difficult about anchoring is that it's really hard to avoid completely. It affects all of us, regardless of our expertise in whatever it is we happen to be dealing with. And there have been studies that have shown that anchoring, even when the anchor is obviously way out of proportion, still affects us. In one such study, participants were tasked with guessing the age of Gandhi's death. The participants were split into 2 groups, with one being asked whether Gandhi had died before or after age 9, and the other being asked whether he died before or after the age of 140. Obviously, neither of these anchors were remotely correct. But when the 2 groups were asked to suggest when they thought he had died, the study found that both groups guessed significantly differently. The group that was anchored with the age of 9 guessed on average a death at the age of 50, versus the group that was initially anchored at 140 guessing an average age of death of 67. Other studies have explicitly told their participants that anchoring was being used and that it would affect their responses in the study. They were told to do their best to correct for this bias, but the results showed that it was still not enough. And these results still held true when monetary incentives were added. But what does this mean for us as investors? Well, a very common anchor point that we use in the investing world is the initial price of a stock or mutual fund that we see when we're researching it. For example, if you bought a stock for $100 a share, because of anchoring, there will be a certain fixation on that price. If the share price goes down because of a market crash, you'll be more likely to think about it coming back to its original $100 per share price because that's what you originally considered it to be worth. And this could be a good or a bad thing. Obviously, if the stock rises back up to $100 a share or more, then your anchoring bias stopped you from selling low, which is a good thing. However, if the stock price continues to fall and never returns to its original value, then you'll eventually have to sell it and lose even more money than you would have had you just sold it right away when the market first crashed, which would not be such a good thing. This effect can be intensified by making us more likely to decide to buy even more shares of the stock during a crash. As I've shown in previous videos on the stock market's crashes, this can be a tremendously good thing because you're buying when the stock is on sale. However, if the stock you're actually buying doesn't recover for one reason or another, then you're pouring even more money into an investment that is no longer worth what you thought it was based on your original anchor point. This is more commonly seen when you're investing in individual stocks than the market as a whole. But just to put some numbers to it, let's say that John was researching a stock that had a share price of $100. Over the course of the next year, the stock dropped from $100 a share to $50 a share. But it still appeared to be a good stock, so John bought in some more while the getting was good. He invested $500 a year into the stock over the course of 10 years. The stock, like John initially thought, was a good one to buy, and its share price increased by $10 per year for the rest of that 10-year time span. And by the time the 10 years had elapsed, the stock had grown back not only to $100 a share, but to $140 a share. And as a result, John's net worth had grown to $8,177.60. However, what if things had went differently? What if instead of rebounding, the stock was actually showing the beginning signs of a long decline? Let's say that instead of rebounding by increasing the share price by $10 per share per year, it instead saw its share price drop by $5 per share per year. This would mean that by the end of the 10 years, the stock would be worth $5 per share. And despite investing $5,000 of his own money into the stock, thinking that it would rebound and have a net worth of over $8,000 by the end of everything, John would only have a net worth of $1,464.48 in this version of the story. This is, of course, assuming that he doesn't eventually just cut his losses, of course, which I'm sure he would at some point during this time span, but the point remains. He saw stock drop and was anchored to that original price he thought it was going to rebound to, and in this particular case it didn't, and he lost money. Unfortunately, as I said, it's very tough to avoid this anchoring bias completely. The best we can do is try to nullify the worst of its effects by taking in as much data as we possibly can and considering all of it when making our investing decisions. And of course, when it comes to investing in particular, diversification can help limit the losses here. The third investing trap Richard mentioned that I'm going to talk about today that keeps us from reaching our full potential is herding. Herding explains the phenomenon of large numbers of people acting in the same way at the same time. As you can imagine, this has a tremendous impact during stock market bubbles where people begin to buy into the bubble as much as they can, in large part because everyone else is doing it. And when those bubbles pop, it can lead to things like people selling all of their investments when the market is crashing. Just because its share price has been so volatile, let's take Bitcoin as an example here. It started off simply enough, only being worth a few cents back in 2010. But of course, it exploded like few things ever before it have, to eventually be worth over $1,200 by November 2013, and over $2,300 by May of 2017, and at its peak, nearly $13,850 by December of 2017. Talk about a phenomenal investment return if you got in early and sold late in 2017. But of course, as we now know, Bitcoin would fall to about $3,400 in January 2019. And as of this recording at least, one Bitcoin is worth around $10,000. That's quite a roller coaster ride, isn't it? Going from $2,300 per Bitcoin in May 2017 to almost $14,000 by the end of the year, and then all the way down to $3,400 a year later. That would be quite a lot to take for most buy and hold investors, and of course most didn't take it. Some managed to buy in when the getting was good and then sell out when it was worth north of $10,000, and they made a ton of money off it in the process, but most did not. If you look at the trading volumes per Yahoo Finance, Bitcoin didn't really start picking up steam until late 2017, when the trading volumes for the month went from somewhere in the range of 12 to 15 million a month in July to over 30 million a month in November and over 76 million in December when Bitcoin was trading at its highest point. But for those who were unlucky enough to buy in at the end of the bubble in November and December when the largest crowd was swarming to Bitcoin, they would see their investments crumble over the next 12 months. In fact, by March 2018, Bitcoin was already under $7,000, and it did continue to drop all the way as low as $3,400 in 2019. And that's quite a big loss to take, and in a really short amount of time if you poured a lot of your savings into the Bitcoin bubble. What's more is this kind of experience, admittedly as extreme as it is, particularly for new investors, can be incredibly damaging long term. If they bought into the Bitcoin bubble and then saw it crash like it did, and then rushed out along with most everybody else, they would have a very tainted view of stock market investing. It would be seen as a tremendous risk for not that much reward by many, and understandably so given their experience. This might trigger some sort of loss aversion within them and make them less likely to invest in the future. Therefore, they'll be less likely to reap the rewards of long-term stock market exposure. This basically cuts them off from taking advantage of long-term compounding interest, and we all know how powerful that can be. Even small investments over a long period of time can build to a big net worth. Take someone investing $100 a month and getting an 8% average annual rate of return. Over the course of 40 years, they will build a nest egg of $325,000. At $300 a month, or about $10 a day, they would have almost $1 million in their nest egg in 40 years. That's quite a lot to lose out on simply because they had a very negative first investing experience. So those are 3 investing traps as covered by Richard of the Plain Bagel that can affect our investing behavior and keep us from reaching our full potential. Once again, if you want to hear Richard's take on the matter, I've left a link in the description below to his full video on the subject. But what did you think of them? Have you ever experienced any of them before? What other investing or psychological traps have you experienced in your investing lifetime? Let me know in the comments section below, and let's get this discussion going.